Hey, what's up guys? Let's talk about what the heck's happening in the market and is it more affordable to buy today versus 2018, 2019? Let's get into it. So according to Zillow's weekly market report, new pending listings were up 22.2% but fell 4.6% month over month and 1.5% week over week. Though the pandemic pushed the buying season back and demand still high, buyers scramble for homes may be calming somewhat. This may be evident as we transition from the summer months to the fall months, so we would see a little bit of decline, but year over year, we're up 22.2% as far as pending listings. Homes nationwide typically stay in the market for 13 days before going pending, in line with levels experienced throughout much of August and September. The number of days homes typically spend on the market before going pending has consistently fallen since mid-May and is now 15 days less during the same week in 2019. So things are speeding up a little bit compared to last year. According to Realtor.com, new listings were down 6%. The number of sellers decided to put their home on the market remains limited. Seller confidence is slowly improving in October, may bring higher than usual number of listings on the market. This is the most important part. Total inventory was down 39%, with high interest from buyers and limited flow of new listings. The total number of homes available for sale continues to shrink. This week saw a hint of good news in that the pace decline remains steady for the second week in a row. This coincides much with Zillow.com. So now let's get into pricing, how things are being affected with a 39% drop in inventory and 22.2% increase in new pending listings. So according to CoreLogic's Home Pricing Insights, their study found that national home prices increased 5.5% year over year in July, with no states posting annual decline in home prices. The states with the highest increase were Idaho 9.8%, Maine 9.1%, and Arizona at 9%. Here are the top metro changes. One of the smallest changes was 0.6% in San Francisco, Houston, Texas 3.9%, Miami Dolphins 3.9%, and Washington at 5.3%. Overall, things are appreciating. Now keep in mind these are metro changes as well as national appreciation at 5.5%. It may be different for your market. Now let's get into what's happening because of the appreciation that we're seeing. Well, according to CoreLogic, homeowner equity in the second quarter of 2020 actually increased by 6.6% or $620 billion. And because of that gain, negative equity actually fell. According to them, it fell by 15% or equivalent to 310,000 homes. Initially, it was at 2.1 million homes that had negative equity and is now fallen to 1.7 million homes. Negative equity is basically when you have more debt than what the property's worth. And because of the appreciation that we saw nationally, it means that people gained a little bit of positive equity and gets them out of the hot seat, which gives you options. If, for example, you are behind your payments, you have the option to sell your property. And if you just got out of that negative equity, it means you can cover your debts, or you can refinance to survive the storm as things continue. Now, as far as the mortgage rates, according to Freddie Mac, October 1st, 2020, the weekly average for a 30-year fixed rate mortgage was 2.8%. And because Freddie Mac's so cool, they present data since 1971, so we can actually see what the interest rate was last year easily. And October 3rd, 2019, interest rates were at 3.65%. So now let's get into affordability. So let's say you have a home that's priced at $300,000 in 2019. You purchase that property, 0% down, and you have an interest rate of 3.65%. Your monthly payment would be $1,999. Now, if that home wasn't sold in 2019 but sold in 2020 with a 5.5% increase, your price of that property that you would purchase that at is $316,500. And the interest rate you would have on that is 2.88%. Your monthly payment will be $1,966, or you would save $33 per month if you were to buy that same property in 2020. Annually, that would be $396. Now, here's the kicker. How much interest do you actually pay over the 30 years? Well, if you purchase that same property in 2019 at $300,000, the lower price point, the total amount of interest that you would pay over 30 years is $193,932.97 versus if you were to buy that same property but with that 5.5% appreciated price and the lower interest rate, you would pay only $156,554.91 or a grand total savings of $37,427.31. That's a pretty significant savings. And if you really wanted to look at it, according to the National Association of Realtors, they have a housing affordability index since 1990. So you can actually see from 2009 to 2015, the years when distressed properties dominated the market. That's distress being foreclosures. Versus today 164. So you can actually see in today at 164. Keep in mind, the way the index works real quick is any number above 100 is positive. It means it's more affordable. And basically the way they determine affordability is based on the front end ratio. And they use a more conservative number, which is 25%. And basically the front end ratio is the subject property that you're looking to purchase. For them, they use 25%. If you watch my previous video, the front end ratios typically range around 28 to 30%. So they're being very conservative. Now, finally, the last question that may be presented, okay, if interest rates are low, how long are they going to remain low for? Well, according to the New York Times, the Federal Reserve's economic forecast suggests that interest rates will remain near zero until 2023. The main reason for that is because even prior to COVID, the Federal Reserve was trying to increase inflation and hit that benchmark of 2%, but they couldn't. So now, because of the shutdown, they're forced to keep interest rates low, which means for first-time home buyers, investors, or anyone else that is in a good financial position or has the financial capability to get themselves in that position can take advantage of the interest rates. So overall, that's my 2 cents. Peace out.